Hello again. Chapter 11, Statement of Cash Flow. Probably one of the toughest topics in the course, if not the toughest. And I have my own way of teaching this. I don't really pay too much attention to the textbook. Not that you shouldn't, but I don't pay too much attention to it because I find that not just this book, almost every book I've seen, in fact, every book I've seen, they talk about it, but they don't tell you how to do it. So they'll talk about it, they'll show you a lot of pictures, a lot of diagrams, arrows pointing in a million directions, but they don't give you step-by-step instructions on how to do this. So, not a terrible idea if you want to skim through the book and just get whatever knowledge they offer you. But if you want step-by-step instructions on how to do this, I think my approach to this is better. Okay, so we're looking at Blackboard, and you can see that there's this link called My Videos and Homework. And this is where I'm posting these videos and the homework problems that I'm working on with you. So you can see for chapter 9, right, here's the first video and the homework problems. Here's the second video and the homework problems. And I did the same thing for chapter 10. Chapter 11, and again, this is a work in progress. I've never done this before with videos like this. So as I'm going through the material with you, I'm going to put the videos up and the homework problems. But these are my own PowerPoint slides that I made. And I made it, there was a different book. So in our book, it's chapter 11. In this book, it was chapter 21. So notice, preparing statement of cash flow using the indirect method. There are two ways of doing this, indirect and direct. You have to come out to the same answer no matter which method you use. I have been teaching and practicing accounting for many years, 6 years. I have never seen the direct method used. The only place I've seen it used is in textbooks. So I'm not going to show you that. I'm not going to hold you responsible for that. We're going to use the indirect method. That's the one that you will probably see in the workplace. Okay. Now, let's see. Let's take a look at these notes. I've been playing around with this numbers program, and I'm slowly but surely getting the hang of it. If we were in a classroom, I would be writing this kind of stuff on the blackboard. But what you see is a T account for cash, right? And the account has a left-hand side, or debit as it's called. It has a right-hand side, or credit as it's called. And you can see from the example, the beginning balance in the account is $10,000. The ending balance is $12,000. So it's safe to say, from looking at that, the cash increased by $2,000. Well, how did cash increase $2,000? Why did cash increase $2,000? You see, the balance sheet will tell you what the beginning and ending amounts of cash are, which is a useful thing to know. You can see cash went up. I guess that's a good thing. But you have no idea why. You have no idea how this company is spending its money. None. So you have no idea how much cash came into the business. You have no idea how much cash went out of the business. And this is what the statement of cash flow will show you. So for example, what if cash increased by $1 million? Right? We had transactions totaling $1 million of debits to cash. Could be from a lot of reasons, right? Why do you debit cash? Well, maybe you sold stock, maybe you borrowed money, maybe you made cash sales, maybe your accounts receivable customers paid you, right? There's a lot of different reasons why you receive cash. But let's say that totaled $1 million. And what if you wrote checks for $998,000? Right? Well, that would explain why cash increased by $2,000, right? It went from 10 up $1 million, down 998, gives you this ending balance of 12. So what the statement of cash flow is going to show you, where did this $1 million come from? Where did this $998,000 go, right? And again, I'm just using these numbers to illustrate a point. Now, way back in the first chapter of the textbook, I believe, they tell you that all activities in a business can be broken down into these three categories: financing, investing, operating. So let's think of a new business that's just started. The most important thing for a new business is to get their hands on cash. You can't have a business if you don't have cash. Those transactions where you get that cash are called financing activities. Now, what accounts do you look at for these financing activities? You'll look at the long-term liabilities and the stockholders' equity accounts. If those accounts increased, it means cash came into the business. If those accounts decreased, it means cash went out of the business, right? Think about it. So now that you started your business and you got your money, right? You went to the bank and you borrowed as much as they would give you. You probably put some of your own personal money in. Maybe you went to some friends and relatives and you asked them if they wanted to invest in your company, right? And you gave them shares of stock, stockholders' equity. Now that you have your money, you go out and you buy the assets that you're going to need. Long-term assets. PPE, property, plant, and equipment. A computer, a desk, a printer, a fax machine. All the things that you're going to need. Again, if you're in a business that requires machines of different types, right? You'll have to acquire those. So you take the cash that you got in the financing activities and you go out and purchase the assets that you're going to need to use. Chances are, if these assets increased, cash decreased. If these assets increased, cash decreased. Again, on the assumption that you used cash to buy them. If these assets decrease, it could be because of something like depreciation, right? Which we'll talk about later. Because depreciation is a factor on the statement of cash flow, definitely. But if these assets decrease, let's say your equipment went from 10,000 down to 8. Well, what it means is you probably got rid of something. Maybe you sold it. So now that you got your money, you have your equipment that you need to start your business. Now you can actually open the doors and see the customers. Those are the operating activities. What accounts do you look at that affect cash that result from these operating activities? Well, as you're going to see, we look at the income statement first, and we look at net income, and then we make adjustments to net income. See how I have plus or minus on there? Plus or minus these various adjustments. We're also going to look at current assets and current liabilities. Did they increase or decrease? Right? So this, in a nutshell, is how you prepare a statement of cash flow, right? But I'm not going to leave you hanging there. I'm going to show you. Okay, so here's another example of a T account for cash, right? Here's the debit side of the account. Here's the credit side of the account. And notice I broke it down by activities. And there may be one or two that I didn't see or I didn't realize, but this is one of those things. This didn't exist in a book. I just sat down one day and said, okay, what are all the reasons why you would debit cash? What are all the reasons why you might credit cash? So let's start with the debits first. And again, for something to get on the statement of cash flow, it has to be from a transaction that either increased or decreased cash. If the transaction didn't increase or decrease cash, it does not go on the statement. So what's an example of something that would increase cash? Cash sales made to customers. Debit cash, credit sales revenue. Cash collected from customers, accounts receivable. Debit cash, credit accounts receivable. Cash received from short-term borrowing. Debit cash, credit notes payable. Right? Remember, notes payable is one of those things. They could be short-term, they could be long-term, right? You need to pay attention. When you see notes payable, don't always assume it's one way or the other. So those are all operating activities. Now, what about credits to cash that are operating activities? Well, what about expenses? Cash paid for expenses. Debit rent expense, credit cash. Right? Debit salaries expense, credit cash. What about cash paid for current liabilities? Debit accounts payable, credit cash. And cash paid to purchase current assets. Debit supplies, credit cash. Debit prepaid insurance, credit cash. Why are these operating activities? Because they affected either the income statement or the balance sheet, current assets, and current liabilities. So whenever you think of operating activities, think income statement first, net income, plus or minus adjustments, current assets, current liabilities. Right. Now, cash received from sale of non-current assets. Let's say you had you bought a piece of land, right, that you paid $10,000 for and you sold for $12,000. You received $12,000 in cash. You have a computer that you paid $1,000 for, and a couple of years later, you want to buy a new one, and the old one is still working. That's not great, but you find someone who you can sell it to for $200. Cash paid to purchase non-current assets. All right, so I'll go out and buy a new computer for $1,000. I buy a piece of land for $10,000. I buy a new copier or fax machine, $5,000. Right? These are examples of investing activities. Why? Because they affected those long-term or non-current assets. Now, financing activities. Remember, financing activity, we said, affected long-term liabilities and stockholders' equity accounts. So think of all the different accounts. We just studied stockholders' equity, right? Think of all the accounts that are in there and what accounts could be affected by that, and how does that tie into cash? So you have cash received from long-term borrowing, bonds payable, notes payable. Oh, I skipped one, but okay. Long-term liabilities, right? Cash received from long-term borrowing, bonds payable or notes payable, debit cash, credit bonds payable. And what could decrease cash? Cash paid to pay down, pay off, or retire long-term liabilities. Debit bonds payable, credit cash. Debit notes payable, credit cash. And what about the stockholders' equity accounts? I get cash received from selling common and preferred stock, right? Debit cash, credit common stock, credit additional paid-in capital, right? What about dividends? Now, dividends, we're going to see here, right? When we studied the chapter 10 and we looked at dividend transactions, we debited dividends and then we credited dividends payable. We debited dividends payable and credit cash, right? So you see the flow of how that works. But that dividend eventually will get closed into retained earnings. So dividends reduce retained earnings. So in this chapter, if we have any dividend transactions, right, I'm going to use retained earnings rather than that dividend account. Because eventually that's where it winds up anyway, right? Debit retained earnings, credit cash. Now there's one that I didn't put here that I just thought of as I was talking. What about treasury stock? I buy back shares of my own stock, debit treasury stock, credit cash. Right? That would belong here too as a cash outflow. And as a cash inflow, what if I resell the treasury stock? Debit cash, credit treasury stock. Okay. So what are the procedures for doing this? How would you start from scratch? You're doing this for the first time, like a roadmap, right? You want a method. You want a way to answer these questions. And if you follow this step-by-step approach, you can do any statement of cash flow problem, right? As long as you remember the basic rules and you apply them to your problem and follow these steps, I can guarantee you can do any statement of cash flow problem. And you may need the notes as a guide because, you don't remember everything the first time you do something. So how is this going to work? In most problems, you'll be given an income statement and comparative balance sheet. In other words, they'll give you 2 years' balance sheets. Very often, they include additional text underneath the problem. And if you want to make sure you're doing this right, you must account for all the information given. Because if you leave something out, right, that might be something that affects cash and your answers will be wrong, maybe. Now, to be honest with you, some of the problems are so easy, you don't need to, you could take shortcuts, but you never know when you're doing the problem initially whether it's going to be like that or not, right? So be careful. So step one, what I like to do, I like to go to the balance sheet and I like to look at the cash line on the balance sheet. And then I look to see whether cash increased or decreased, how much. I write that number down somewhere. That's the number that I have to wind up with, right? I said here, this is the number you must account for. That's the place you have to wind up. So if cash increased $2,000, by the time you're done, when you add together operating investing, financing, it has to come out to $2,000. Now, one could be 100,000 up, one could be 97 down, another could be 1,000 down, right? And that's how you wind up with the $2,000. So again, you have to wind up with that amount. So in a way, this is good because you already know the answer. If you look at that as being the answer, which I think it is, you already know what the answer is before you start. Now you go to the income statement. And you're going to pick certain things off the income statement. Net income is the starting point. Now remember, net income is an accrual basis number. In other words, included in that income are sales that came through accounts receivable, not cash, right? Included in net income were expenses that recorded with accounts payable, for example. So what we're going to need to do is to convert that net income from an accrual basis number to a cash number. So we'll see how to do it. Sounds a little kooky in the beginning, but once you've done it a couple of times, it's not bad. So we start out with net income. The next thing I look for is depreciation expense. Now, similar to depreciation expense is something called amortization expense. Intangible assets amortize, property, plant, and equipment depreciate, right? So depreciation and amortization are basically handled the same way. I don't know if we'll even see amortization in the problems we're doing, but just be aware amortization is similar to depreciation. And then we look for what I call non-recurring gains and losses. Did we sell anything like land, like equipment, like investments? Did we sell anything that resulted in a gain or a loss? Now, if you want to refresh your memory, you could go back to chapter 7. And in chapter 7, let me see if I can find the pages. Chapter 7 was the chapter on long-term assets. Right, that's the chapter where you learned how to depreciate. You learned the issues involved in acquiring assets. Okay, beginning on page 365 and going over a couple of pages, 365 to 368. They take you through the journal entries for disposing of these assets. So you could either sell them, in which case you receive cash, and that's important for this chapter that we're working on, right? If any of these assets are sold, cash was generated. Now, sometimes the problem will tell you how much cash is the transaction generated. Other times they won't. You'll have to figure it out. So you can look to see what those entries were. You could either sell the asset, just throw it away. They use the word retirement for that. Or you could trade it in for a new one, right? But the only one that affects cash is the outright sale. Now, you could have gains or losses from doing something like that, right? And again, I'll show you when we go through the homework, right? So now you can start to prepare the statement. Take your piece of paper and divide it into 3 parts. Cash flow from operating activities, cash flow from investing activities, cash flows from financing activities. Now, the longest part usually is the operating activities. So just make sure if you're doing the problem by hand, you leave enough room for that. Start with operating activities. This is the longest and most difficult to prepare. Keep in mind that in this section, you are attempting to convert net income from an accrual basis number to a cash basis number, right? So you list amounts in this order. Start out with net income, add depreciation expense, add any of those non-recurring losses, subtract any of those non-recurring gains. Now you should be finished with the income statement. You're not going to have to go back and look at the income statement again. Right? So if you pick all these things off, you can put the income statement away. Now you turn to the balance sheet. You look at the current assets, you look at the current liabilities. You look to see what the year-over-year increase or decrease was. Right? And then you do the following. If any current assets decreased, you add that amount, right? The amount of the decrease. If any current liabilities increased, you add those increases. If any current assets increased, you subtract the increase. And if any current liabilities decreased, you subtract the decrease, right? In my opinion, this is the hardest part. This is the confusing part. Why? Because you're adding a decrease and you're subtracting an increase, right? It's kind of counterintuitive. So with the assets, you've got that craziness, right? You're going to add decreases and add decreases and subtract increases. With liabilities, it's the opposite. Add increases, subtract decreases. Now, again, how did I teach this to myself when I was in your place many years ago? Too confusing. I say, okay, let me just remember current liabilities, add increases, subtract decreases, and then current assets is the opposite. And then just tread very carefully when you're doing that. Add all those numbers together. And if you wind up with a positive number, you're going to call it cash flow provided by operating activities. If it's a negative number, you'll call it cash flow used in operating activities. So that's operating activities. That's usually the toughest part. Here, what I did is I gave you a sample of that operating activities section and what might go in there, right? So you start out with net income, and then here are your adjustments, plus or minus. What numbers do you pick off the income statement? What numbers do you take off the balance sheet, right? See how I broke it down for you so that you know where to look. Now, this is overkill. I use these same notes for my intermediate accounting class. But in the intermediate accounting class, it's the same basic idea, but some of the accounts are weird, right? They're just, we haven't seen them. So if you take intermediate accounting, before you get to the statement of cash flow, we see statement of cash flow in that course is the last chapter in the book. So it assumes that you studied all these other topics first. So you have this here, but I doubt you're going to need to look at it. Right. Now, investing activities. Analyze the changes that occurred in the non-current asset accounts. What I like to do is I like to draw T accounts for each one. I fill in the beginning and ending balance. And then I try to figure out why did it change. Now, sometimes there'll be text in the problem that'll tell you things. Always look for that first. But what if they don't tell you? What if they just told you that land went from 10,000 to 8,000? Well, what's the only reason why land can go down? It means you sold it. You sold land with a cost of $2,000. I don't know what you sold it for. That's the other thing you might have to figure out. What if land went from 10 to 12,000 and they don't tell you anything else? What's the most likely reason for that? Well, it means that you bought land. So increases to these assets most likely represent a purchase of a new one, resulting in an outflow of cash. Decreases most likely represent the sale, resulting in an inflow of cash. And another thing to do, analyze the accumulated depreciation account. Now remember, accumulated depreciation contra asset, an asset account with a credit balance. Write in the beginning balance, write in the ending balance, and write in what the depreciation expense was. So if I take the beginning balance of accumulated depreciation and I add whatever depreciation expense was, I should get the ending balance. But what if that doesn't add up? If that doesn't add up, it means that a number belonged on the debit side of that account. And if there's a number on the debit side of the account, that means one of those assets was sold. Right? So again, if you go back to chapter 7 and you study those pages, you'll see anytime you sell one of these assets, you have to debit the accumulated depreciation account. Add all these numbers together. Some are going to be plus, some are going to be minus. Add them all together. The result will be cash flow provided by, if it's positive, or cash flow used by investing activity. Financing activities. Financing activities, go back to the balance sheet, long-term liabilities, stockholders' equity accounts, draw the T accounts, enter the beginning balance, enter the ending balance. Why did they change? Increases to these accounts most likely represent cash coming in. Decreases to those accounts most likely represent cash going out. Look at your retained earnings account. What affects the retained earnings account? Retained earnings has a beginning balance. It's increased by net income. It's reduced by dividends. And that's how you get the ending balance. Right? So when you analyze everything that took place in the retained earnings account, right, sometimes they tell you the dividend, sometimes they don't. But if they don't, you should be able to figure it out. Combine all the numbers in that section. If it's a positive number, it's called cash flow provided by. If it's a negative number, it's called cash flow used. Add the three sections together. The result will be the increase or decrease in the cash account, which was the number that you started with, right? Go back to the beginning. What was the first thing we did? Go to the balance sheet and look for the net dollar change that occurred to the cash account. Right? So the number that you wind up with has to be that number. If it's not, you made a mistake. Now you're almost finished. Now you have to take that number that you calculated here, number 7, right? You take that number and you combine it with the beginning balance of cash, and that should give you the ending balance of cash. And now the statement is complete. So I'm going to stop here, and I'm going to do another video where I'll go over the problems with you.